Okay, hello everybody and welcome to this really short tutorial where we're going to talk about loans. Loans are a very important topic that you want to understand and discover because later on you are either going to ask for a loan when you become an employee or an employer, or you are going to work with loans with your employees. In our case, every time that you ask for a loan with a bank or any financial institution, you will get a table, an amortization table that will show you the payments, what you owe, and of course what you have paid up to the date. Okay? And this is very easy using Excel because you can create the whole table where it says all the payments and what are you adding to the debt and what is the remaining of the debt. Okay, so the very first thing is to start with a few labels or names that we're going to talk about. And the first one is the capital. This is what we're going to owe the very first time. We're going to talk about an annual interest rate. Okay, we're going to talk about an annual interest rate, and we're going to talk about a monthly interest rate. Okay, we are also going to talk about the number of payments that the person is going to develop or that you require the loan for, and we're going to talk about the monthly payment. This is something that we're going to use a formula in Excel, which is PMT, and it's very, very simple to use. So let's start with a very practical example. You're the employer, and since they are lending money at a very high interest rate in the banks, you decide that you want to help your employees with lending them some money. Okay, lending them money, and you are gonna just deduce that money from their payments every month. Okay, so that is like kind of like a lot of help for your employees because they're going to be more proficient and they don't have to go and ask for money in the banks, and that way you can also help them out. Okay, and the money is there, they're going to work for it, so they're going to be you're going to take it from every monthly payment. Okay, so let's say that one of the employees comes to you and says he requires 1 million pesos. Okay? In this case, he requires 1 million pesos. And you are going to set up an annual interest rate less than the one they pretty much put in the bank. So in the bank, they're using probably 22% annual interest rate, and you're going to tell them that you're just going to charge them the 12% of the annual interest rate. So the monthly interest rate, okay, the interest rate that you are going to apply every month is going to change a little. We're going to see in a future tutorial that this is going to change. Okay, we're going to talk about effective and nominal interest rates, and that is a little bit different. But for now, let's just say that the monthly interest rate is just this value divided 12, which is every month. Okay, so it would be 0.01. I'm going to add just so we know that this is the monthly interest rate and the number of payments. And the employee says, well, actually I can pay this in a year. So you're going to add the number of months, always in months. And here we're going to set up the formula. So we're going to type in PMT, and it's going to ask us the rate, the capital, the rate, the number of payments, and the capital. So the rate, we're going to choose this one, the number of payments, and the capital that we are going to look for. Now, FV is when you're going to pay. You're going to pay at the beginning of the term or at the end of the term the interest. Okay, so in my case, let's just type 0 and 0. So we have 5 parameters. Okay. Oh, this fourth parameter is just where do you want to end the payment. So you want the payments to reach 0. This is the final value. Okay, the final value of this iteration will be 0. Okay, and of course the type is at the beginning of the period or at the end of the period where you want to make the payments. So you always make it at the end of the period. Okay, so as you can see, you get 88,848. Okay, so this is the monthly payment of that employee if he wishes to pay everything in 12 months. Now we are going to create the amortization table for him. So the first thing we do is that we set up the 12 payments. Okay, we're going to handle this up to 12 because we want to make 12 payments, of course. And of course, our monthly payment is going to be this. Okay. Something important about PMT is that this is a negative value. We always subtract from that negative value. So what I'm going to do is that I'm going to add a minus just so I can get a positive value and work with it. Okay. So I added a positive value. I'm going to say that this is this value and it's never going to change, so I put it in absolute cell reference. So this does not change. I'm going to pay exactly the same thing every single month. Okay? Now something that we should do is that you always start with whatever you owe. So let's type here a few labels on top. So this is going to be the payment. This is the interest that you pay. This is capital that you're paying, because you're always adding to the capital, of course. Otherwise, you're never going to settle the debt. And the actual debt. Okay. So this is something that we always do. So we start the debt. And we can start the debt by saying that this is the first one that we created. Take this couple of decimal places. Okay, so the interest is going to be based, whatever is the interest is going to be based on your current debt. Okay, so in this case, we're going to say that is whatever I owe from last month times the monthly interest rate. Now the monthly interest rate is going to be an absolute value. Okay, so from this amount of money, I need to pay 10,000 pesos. Sorry. Okay, so let's format all these cells so we can see them better. Let me just format all this, and let's try to put it in currency with no decimal places. Okay, and here I can view my numbers better. So this is the amount of money that I'm paying for owing this amount of money. Okay, so I'm going to pay this. Now the capital will be from the payment. I subtract the interest, and I'm going to get whatever I'm adding to the capital. So this would be this minus the interest, and I'll get 78,849. So I'm paying this for interest and this for capital. Now the debt would be subtracting only the capital, because remember, the interest is the money that you're gaining just for lending the money to your employees. Okay, this is what you gain. Okay, now it's going to be whatever I owe from last month minus the capital from this month. Okay, So at this point, I owe 921,151 pesos. Okay? Okay, so now that we have our values, we are just going to fill handle everything else. Because I'm going to fill handle this. You're going to see that all the values are going to start to come up as soon as we fill handle everything. Okay? Okay, now this completely changes because it has to do. You know that you did the amortization table correctly if the final payment, after paying the final payment, you get 0 on the debt. This is where you need to get, okay? So this means that this person will pay everything in 0. So if you want to know what the company wins or actually gains from lending this money, you just add all the interest. We'll see what are the benefits of lending money to your employees. Well, there are some pros and cons, of course, but as an employee, as an employer, you want to do this sometimes, okay? Or create a fund somehow, and that fund can lend money to employees. So for lending that money to this person, you will earn 66,000 pesos. You can say that that is not a lot of money, but you are just pretty much moving your money. Okay, we're talking about 1 million pesos only. And of course, it is a very low interest rate. Nowadays, if you see some other banks and some other institutions, it's a lot more expensive, okay? So here we have, let's see this, okay. And 1% is really, really, really low. Nowadays, credit cards are 2.3, 2.4, even 2.5% monthly, okay? So good luck with this, and this will help you for our loan exercise.